Institutional investors have been in the past quite passive investors, but I can only recommend at the end of the life of the funds for them to be a lot more active.
Christiaan, the last time you were here, we were talking about how institutional investors were investing through private equity via dedicated assets. But this is quite an illiquid asset class. Can you firstly tell us how these funds are structured and then how are they liquidated?
Sure. Institutional investors that invest in private equity typically do so through limited partnerships, and they make a certain commitment to these limited partnerships. As these vehicles make investments, as the managers choose investments to invest in, capital is called from these investors. And later on in the life of these funds, as these investments or these assets or these companies are sold, money is then returned to these investors. And these partnerships are typically structured with a 10-year life, with the possibility to extend it for a couple of years after that.
But that's quite a long time, so are all funds liquidated within that time frame?
No, it's actually the statistics are quite scary. I think only about 12% of the funds are liquidated within the initial 10 years, and only about 20% of the funds are liquidated within the 10 plus 2 years, within 12 years. It doesn't mean that you systematically have a lot of assets left after these years. It could be just maybe a few assets left, but in some cases you still have substantial asset base after 10 or 12 years.
So after that 10 to 12 years, what happens if you do still have a number of assets or investments left?
There are a number of options available for the managers. I think traditionally and still available today is just to extend a fund further. You go to 10 years, you extend for a couple of years. If you still have assets left, you can extend for as long as the investors approve it, for as long as you want in a way. And if your investors don't approve it, you will go into liquidation. But then you can run a fund in liquidation for several more years as well. So it is not rare at all to see funds which are 15, 16, 17 plus years in the market. The second option is after the end of the life of a fund, if you still have some asset left, the manager can decide to sell all of these assets as a portfolio to a secondary buyer. That's what's called a secondary direct. So you just dispose of all the assets and they move on to someone else. More recently, in the last couple of years, we've seen a third solution emerge as well in the market. It's something called a GP-led restructuring. What it is the existing manager of a fund working with someone that provides liquidity and offering a solution or an option to all of its investors to either sell for cash its position in the fund or remain involved going forward in a new structure in a way. So it's a new set of terms, a new set of governance. The manager typically has a new set of economics. But basically at the end of the life or at that point in time, the investor has that choice of selling out or remaining involved.
With these options, is one better than the other? Have you noticed a trend of more leaning towards one or the other?
It really depends a little bit on the circumstances of each fund and each situation at the end of their lives. For example, if you only have one asset left and you're undergoing a sales process and it's going to terminate quite soon, you might as well extend it and finish that process. If as a manager you are not that motivated, or you're managing other assets, or you've lost part of your team that has made these investments, you might as well go through a secondary direct and just sell off all of these assets on the market. However, if you as the manager still want to manage these assets, but a large part or part of your investor base want liquidity, then a GP structuring is a really good solution because you can offer this option to your investors.
Okay, and so what are the main takeaways for institutional investors?
That's a very good question. And when you present these three solutions, it seems like it's one or the other. Actually, it could be, depending on the situation, a combination of one or the other. And it's not as obvious which one is the best for the investors. And frankly, we've seen sometimes managers not always acting in the best interest of their investors. And some of these solutions comes with pretty strong conflicts of interest. To give you an example of one of these conflicts of interest, for example, the GP restructuring. The manager offers liquidity to its own investors, but remains involved on behalf of a new investor. And his realignment comes quite often with a share of the profits, so a carried interest, based on the purchase price or the value of the transaction at the time. So that gives this perverse effect that he has an interest of getting a transaction done at a very low level, but he still has a duty to get a very high price for his investors. So the takeaway a bit for investors is that institutional investors have been in the past quite passive investors. But I can only recommend at the end of the life of the funds for them to be a lot more active and follow and monitor very closely what's happening and speak to each other and speak with advisors, speak with the manager to make sure they really understand the motivation of the various parties and find a solution that sort of is a good solution for everybody. So it's really about getting the institutional investors a lot more involved with their investment than they used to be in the past.
Well, Christiaan, thank you so much for coming in today and sharing your insight with us.
You're welcome.
That's all from myself and Christiaan today, but if you like this video, there are plenty more on our website, dukascopy.tv.